Hello, everybody. Happy Tuesday. It's Don Garman here again from Mirador Capital Partners. And as promised, we wanted to catch up with you for a couple minutes as our investment committee concluded a little while ago. And I thought I would go a little bit off piece today and talk about some things, do my screen share and chat with you about a, a comment mentioned seriously, but halfway in jest that I thought was worthy of following up on. So, pardon the screen share transition, but so what you should be looking at is a view of my desktop. And it's impossible for you to discern all of the symbols and letters because they will be very small. I think a lot of you maybe even listen on your phone. But what I want you to pick up from this is across the top, you see one, two, three, four, five, six out of seven bars that are green and upward facing, and one that is red and downward facing. So this discussion has to do with the difference between growth stocks, which are very much in vogue at the moment. As you have heard, they were 20 years ago in the late 90s and early 2000s, and value stocks, which are very much out of favor currently. So what the bars represent are the strategies that we offer to clients. The only strategy that we have that really is value stock oriented is our income opportunity strategy. And what the relationship between those comments or words or terms are is in value stocks are, you know, energy stocks and utilities and REITs and call it old economy companies that have established businesses, stable cash flows, so much so that they have excess cash that they don't need to invest in, in capital and equipment, and they pay dividends to their equity shareholders. Well, that's why those companies and the companies that do that meet all of those criteria have tended to pay higher dividends over time, right? They have good management and they have known businesses and known opportunities. And so once once they've done what investing they need to do for the future, they return capital via dividends, not just via buybacks. And so a little bit more esoteric is the fact that the companies that don't pay cash dividends, and it's become very popular to return shareholder capital via buyback. So you buy back your stock, and it was originally intended just to replace the stock that you're paying your management team, so that you don't create overall dilution. And now it's become really sort of a financial engineering instrument to tighten the supply of your stock and keep it going higher. No secret, that's how a lot of most all of these managers get paid, is by virtue of which direction the stock goes. So my point is, the question I was asked is, when is value going to start to reassert itself in the discussion? And the answer, of course, is no one knows. It has been years. And it was actually the largest value outperformance against growth was in the aftermath of the financial crisis in 2001, 2, 3, and some years thereafter. So why I bring this up is because there is a significant number of our clients that are currently retired, and they rely on the income from the income strategy and the dividends of those companies to augment their expenses and meet their cash flow needs. So the temptation, I think, is to abandon that entirely in favor of the other strategies which are currently more popular and in vogue. The risk of that, of course, is that this growth domination has been, 5 straight months on top of 5 straight years. So it's the risk is that you are kind of late to the party and that you end up, really entering the party at an inopportune time. and only time will tell, and no one knows in advance. So as I've always explained our income strategy, and not everybody owns it, but I've described it like owning an apartment building, which is if you own an apartment building and your rents are coming in every month on the first of the month, then and you raise your rents every year to get a little more income, then you don't have to be overly concerned with what the value of that apartment building is in any given year, because if you're not going to sell it, it's not important necessarily that it's going up. But over time, the value of the apartment building ought to follow the path of the rents. That's generally how they are valued, is as the rents increase, the value of those cash flows also increase. And so that is my simple metaphor for the income opportunity strategy. And those of you who would like it to go up, I am complete in agree. I am in violent agreement. I would like it to go up as well. But those are also the type of companies that are especially hard hit by the pandemic and have had to take on some debt or raise some equity to get their businesses through this very challenging time. I know if you live in our area and you hold our strategies, it's easy to forget that it's a very challenging time. But for a lot of individuals, families, and small business owners, it's an incredibly challenging time. And those businesses could have a longer path out, than the capital light companies that are working so well currently. So we'll consider that our little trade school, our little investment education minute on our income opportunity strategy, and we'll leave it at that. So we will talk to you soon. I will certainly reintroduce others into the conversation, but I don't want to, make it stale or do the same thing every week. So we try to mix it up a little bit, but who knows what the future brings. Here we are in September, and who would have thought that we would already be in September? Feels like there was a couple blanks in there as we all sat at home, but now it does feel like, certainly gauging by my anecdotal parking lot meter, that things are starting to get back to normal. More cars here all the time. So hope you're safe, and we look forward to talking to you soon. As always, ping us if you have anything you'd like us to discuss or just want to chat about anything at all. Thanks. Bye.